Thank you all for being here today. Very excited to have you learn more about the Corporate Transparency Act. This is new federal regulation that's been in the works for a while, but officially goes into effect January 1st of this year. A lot of stuff is still developing around it, but there are some dates set in stone. So we have partnered with Jonathan B. Wilson and the FinCEN Report Company to come in to talk to you today to give you a little bit more information about it so you all can be prepared. This is regulation that will likely affect all US-based startups. So to give you an overview of what's required, so you can get some outlook on what's going to be happening in the new year as this develops, and potentially have a custom-built, ready-to-go solution to meet the filing and compliance requirements. So with that, I will turn it over to you, Jonathan. Thank you so much for being here today. We will record this and send it out after the fact. And if you have questions during the presentation, please pop them in the Q&A and chat, and I will hand them over to Jonathan as we go, or in the Q&A after the session. All right, Jonathan, thanks again. Take it away.
Okay, Peter, thank you so much. Are we showing the slides right now?
Yep, I'm going to put them up right now.
Okay, not a problem. So, folks, thank you so much for joining me. I really do appreciate your time. As Peter said, I'm Jonathan Wilson, and my company is the FinCEN Report Company. You can find out more about us at fincenreport.com. Now, let me go ahead and advance to the next slide. What I want to do today is talk a little bit about the Corporate Transparency Act and how it applies to your companies. Some vocabulary words you need to get under your belt. We use the word reporting company. Under this new law, a reporting company is a corporation, an LLC, a limited partnership, or any other legal entity that is formed by the filing of a document with the Secretary of State. Some reporting companies are exempt. We're going to talk about those later. It is the non-exempt reporting companies that are going to have to file their reports under this new law. And the reports they file are called Beneficial Ownership Information Reports, or BOI reports. And inside the BOI report, the reporting company is going to have to identify its beneficial owners and provide 5 pieces of PII with each of those beneficial owners. But beneficial owner doesn't mean just anybody who owns a stake in the company. It is a very specific defined term, and that's what we're going to highlight for you in the presentation today. So why don't we go on to the next slide. The Corporate Transparency Act, as Peter mentioned, is a law that Congress passed at the end of December 2020. You'll remember Donald Trump was still president. This was a law that was passed by both houses of Congress. President Trump vetoed it, and then in a rare moment of bipartisan agreement, both houses of Congress overrode that presidential veto, and this thing became a law. As a result, it has both Republican and Democratic support, and it's highly unlikely that Congress is going to change it. Now, the law required FinCEN, which is Financial Crimes Enforcement Network, it's a division of the U.S. Treasury Department. It actually required them to have implemented this law more than a year ago, but FinCEN has been rather slow. They have finally finalized their rules. They finalized them at the end of 22, and they are going to take effect on January 1, 2024. And as a result of this new concept, the Corporate Transparency Act is basically going to eliminate corporate anonymity in the United States. The information that reporting companies file with FinCEN is going to be confidential. It's going to be kept by FinCEN and not disclosed to the public, but it will be used by the US government and by some foreign governments and even by some state and local governments for law enforcement purposes. The primary purpose of the law is to fight money laundering. You might wonder, what has money laundering got to do with me? I'm a member of several different LLCs that are going to have to report, and we've never really thought about money laundering before. Well, as you can imagine, if you're a bad guy, right? You think about Breaking Bad, you want to find a way to take your illicit money and then launder it through a legitimate business, pay taxes, and then you have clean money, money that you can actually spend. Remember at the end of Breaking Bad, he had those barrels full of cash in the desert he couldn't do anything with because they hadn't been laundered. Well, the way you do that today is with an anonymous corporation. You have an anonymous corporation that no one knows who owns it. You take your illicit money, you open a bank account for that anonymous corporation, you then pass it on to a second anonymous corporation, you then dissolve the first one and eliminate all trace of who owned it, and then the second corporation can say that they earned that money legitimately. Well, by implementing the Corporate Transparency Act and basically creating a database in Washington of all of these private companies and who truly owns them, it'll be impossible for corporations to remain anonymous anymore. Let's go to the next slide. So how the CTA works is that every reporting company that's not exempt is going to have to file this beneficial ownership report with FinCEN. Now, for everybody here today that has a company, relax. You have a lot of time left to go. Any company that exists prior to January 1, 2024 will have until January 1, 2025 to file their first report. So you have more than 12 months to go. Doesn't mean you should fall asleep and forget about it, but it does mean this is not a crisis just yet. Any company that is created on or after January 1, 2024 is only going to have 30 calendar days to file their first report. But put a footnote on that. There is a pending rulemaking in front of FinCEN that would extend that 30 days to 90 days. We don't yet know if that is going to become a rule. We could find out any day, or we could find out a month from now, but there's a possibility that your 30 days will become 90. Just remember that when I talk about the 30-day deadline going forward in this presentation. Now, once your company files its first BOI report, there is no annual update. This is not like a tax return that you have to do every year. But remember, we're disclosing 5 pieces of PII for every one of your beneficial owners. If any one of those pieces of PII should change, the reporting company has only 30 calendar days from the date of the change to file an amendment with FinCEN. That is really tough. Ordinarily, startups, we think about investors as the people who give us checks so that we have cash so that we can go out and build the business. We might owe them financial reports. We might owe them dividends if we're successful, but we don't think of ourselves as having a constant exchange of data back and forth so that if they move their home address, we're going to find out about it. Well, the CTA changes all that. And that's one of the key features of my company's software, but that puts you in touch with your investors in a recurring and continuous way so that you become aware of data changes that gives you the ability to comply with this requirement to file your amendment within 30 days. It's important that we find a way to get this done right, because under the regulations, a failure to file is a $500 per day fine, up to a total of $10,000. And if the government thinks that you are willfully failing to file, it can be punished as a felony. That means jail time. Let's go ahead on to the next slide. I don't want to take you back to law school and get real deep into the weeds. I mentioned this earlier, but this is the definition of a reporting company. All of your LLCs and corporations and limited partnerships are all reporting companies. They're going to have to consider whether they are exempt or not. There are some unusual entities, like trusts, for example, that sometimes are and sometimes aren't. It all depends on whether or not the entity is formed by the filing of a document. So, for example, a Delaware statutory trust is formed by the filing of a document with the Delaware Secretary of State. But in my home state of Georgia, an individual life insurance trust is a private contract. There is no filing with the Secretary of State, so that would not be a reporting company. If you are one of those entities that is formed under the laws of a tribal jurisdiction, for example, you might be a Mohawk Nation corporation. That's a very rare thing, but they exist. Those entities are reporting companies for purposes of this new law. So that's step one. Are you a reporting company? Oh, and finally, if you happen to be an entity formed outside the United States, you might be a French SA, or you might be a German GmbH, for example, and you're doing business in the United States, and you've filed with the state in order to be doing business as a foreign corporation. Even though you're still a German entity or a foreign entity, when you register to do business by the filing of that document with the Secretary of State, you also become a reporting company for purposes of the CTA, and you're also going to have to file a beneficial ownership report. Let's go on to the next slide. Sorry about that. Another customer calling me about the beneficial ownership report. So if you're a reporting company, you're not exempt, you're going to have to identify all of your beneficial owners. Who is a beneficial owner? They come in 2 types. First, you are a beneficial owner if you own directly or indirectly 25% or more of the ownership interests of each company, of the reporting company. And we're going to talk in a second about how do we count 25%. You can also be a beneficial owner even if you don't own anything at all, if you exercise substantial control. But substantial control doesn't mean you have the power to make things happen. Substantial control is a defined term in the regulation, and most companies are going to need legal advice on this, that actually has a multi-part test that includes a whole bunch of things. So for example, every senior officer of the reporting company has substantial control and is therefore a beneficial owner. Persons on the board of directors almost always have substantial control and need to be counted. And any person who has the ability to influence a major decision, which can sometimes just be a shareholder who has a power to vote, can have substantial control and therefore be a beneficial owner. So this is a complicated concept. In the software that we make available to the law firms that use our solution, we have what's called a compliance wizard that walks you through the logic of this. I'm going to show you a little bit more about that in a second. But for business owners, we strongly encourage you to get legal advice, to walk through this very complicated analysis to make sure that you properly identify all of your beneficial owners in the context of preparing your first report. Let's go on to the next slide. Now, I talked briefly about exemptions. There are 23 different categories of exemptions. I wrote a book, the Corporate Transparency Act Compliance Guide. It's very long and boring. Don't try to read it, although your lawyer should. But inside of there, I spent an entire chapter talking about the 23 different categories of exemption. In general, exempt companies are those that have some other form of reporting to the government so that the government knows who they are and who are their beneficial owners. You can just look at some of the lists here. A securities reporting issuer, that's a company that's gone public. Obviously, they filed ownership reports with the SEC, so the government knows who they are. Banks, bank holding companies, securities broker dealers, accounting firms that are registered with the PCAOB. These are entities that all have public documentation as to who owns them. The one exemption here that folks are going to want to know about, let's see, do we cover this later? Let's talk about that real briefly right now. And that is the large operating company exemption listed here. That's in the upper right-hand corner. A large operating company is an exemption that applies if the entity has more than $5 million in revenue as reported on its last tax return, plus 20 or more full-time employees in the United States, using the definition of employee from the Affordable Care Act or the Obamacare Act. Now, if you have $10 million on your tax return and you have 100 employees, you're definitely exempt. You're good to go. Be careful, though, if you are close. If you had $5 million last year and you have 21 employees, because you might be exempt at the beginning of the year, but then if 2 employees leave and you don't replace them, you're now down to 19. The moment that 20th employee has left, you have fallen below the threshold and the 30-day clock begins ticking by which you must file the first report. For business folks, this is going to be really tough to track. But for lawyers, they're going to need to find a method of keeping track of these data changes. That's one of the features in the software that we offer to our customers. Let's move on to the next slide. Don't want to dig too deep into the weeds here, but for the average startup these days, you're a corporation. You have common stock, usually split by the founders. You then might have some safe investors. Maybe you have 1 or 2 classes of preferred stock. Let's keep that in mind as we try to apply some of these rules. You're a beneficial owner, remember, if you have 25% or more, or if you have substantial control. This language only relates to the 25% ownership test. How do we calculate 25%? Is it just 25% of the common stock, or do we have to calculate the preferred stock? These rules tell us, and they're right there in FinCEN's regulations. First, we're going to measure our percentages all at the same time as if any options or similar convertible interests were treated as being exercised. In other words, it's sort of like your fully diluted equity calculation. If you're a partnership, then there's a slightly different method of calculating percentages. I'm going to ignore that for now. If you're a corporation, there are 2 ways that you can have 25% or more. One is if you have 25% or more of the total combined voting power. The second is if you have 25% or more of the total combined value of the ownership interests. Now, voting power is relatively easy to calculate. Remember that we're calculating preferred stock and warrants and other convertible interests as if they have been deferred. You simply do your fully diluted equity calculation, figure out what the vote would be if everything converted to common, figure out if anyone has 25% or more, and if so, they go on your list of beneficial owners. But we also have to do the total combined value test because this is an either or combination. It's not a one or the other. Total combined value. Well, how do we know the value of the company? Most startups, you might have a hope of what your value is. You might have a value based on what the last investor paid. You might have a 498 valuation if you're really sophisticated. But most of us don't really know what the distributable cash per share would be if we actually tried to liquidate the corporation today. Well, that's a bit of a challenge because we're supposed to try to figure that out. Since you don't really know what your total combined value is, unless you're a corporation that holds nothing but cash, you can do that analysis, but you're not really going to have a reasonably certain outcome. Well, the good news is that subsection D gives us the next part of the test. So if our calculation doesn't give us a reasonably certain outcome, we're supposed to use the fail-safe rule, which is that we include as a beneficial owner any person who has 25% or more of any class or type of security. So for many corporations, we're going to calculate voting power. We're going to try to calculate total combined value, but we're ultimately going to have to rely on that fail-safe rule so that 25% or more of the common and 25% or more of any class of preferred would count as being a beneficial owner, even before we worry about substantial control. Now, I know I'm going really fast. I'm going to try to get through everything all at once and then come back and answer questions at the end. So bear with me. Let's go on to the next slide. Don't need to spend a lot of time here. This basically shows the logic behind the rationale here. You begin with figuring out whether you're a partnership or a corporation. You then are applying either the partnership rule or the corporate rule. If the outcome doesn't produce an outcome with reasonable certainty, then you go to the fail-safe rule. Let's go on to the next slide. Now, after you have a list of everyone who is a beneficial owner by virtue of ownership percentage, next you need to add to the list everyone who is also a beneficial owner by virtue of substantial control. You are a person who is a beneficial owner if you serve as a senior officer of the reporting company. Senior officer is a defined term. It includes the CEO, the CFO, and the general counsel, and any person who serves in that function regardless of their title. So you can't get away from being a beneficial owner by calling yourself the Assistant Vice President of Janitorial Services if actually you function like a CEO. The law wants us to look at the substance, not the outer titles. You are such a person with substantial control if you have authority over the appointment or removal of a senior officer or a majority of the board. And in subsection C, you are one of these if you direct, determine, or have substantial influence over important decisions. Now, this is where it gets tricky. Let's imagine that you have, once again, a corporation, you got some common stock, you got some preferred. Let's imagine that there's a shareholders agreement, which says that before the board of directors can do a merger, borrow money, incur liens on the assets, and take other major decisions, we have to put it to a vote of the shareholders, and the preferred shareholders get to vote on that. Well, that vote is going to be over an important decision. The vote of the preferred shareholders is going to have substantial influence over those important decisions. Now, there's no bright line test here, but the advice that I've been giving clients is if you have that kind of a shareholder agreement in which shareholders can vote on important decisions, then they probably have substantial influence, and therefore they should all be counted as being beneficial owners, regardless of the percentage of stock that they own. Again, this is a legal judgment. You can't really rely on my off-the-cuff opinion. You need to talk to your own attorneys about this, but it's something you're going to want to be sensitive to. And to the extent that you're right now in the process of figuring out a shareholders agreement, this would be an issue that you might want to focus on and make sure that you get advice of counsel on it. Finally, don't forget about subsection D. If you are a person who has any other form of substantial control over the reporting company, you still must be included. Unfortunately, FinCEN hasn't really defined what that means, but you can see what they're trying to do here is cast a very wide net because they want to build the biggest database possible of beneficial owners of private companies. Let's go on to the next slide, please. So, again, relax. If you exist as a corporation today, you have until the end of next year to figure this out. We have the regulations that were published at the end of 22 that tell us how we calculate beneficial ownership. But what we don't yet have is FinCEN's portal. FinCEN is supposed to be launching this website before January 1 that in theory should allow individuals to log in and upload all this data, including their home address and their driver's license and all that stuff. Everybody here is involved with a business that has a website. Have you ever gone and done a hard launch and not actually soft launched your website in advance? No, of course not. We'd never do it that way. Only the federal government in its great wisdom would ever try to launch a website this way that's going to have more than 30 million users. So you can just imagine the sort of epic goat rodeo we're about to see with the FinCEN portal. I hope it works. I really do. But if it doesn't, it is definitely good to have another solution to collect and collaborate on your data in a way that's going to allow you to file and not leave you at the mercy of the government. That's one of the reasons that my company exists, to help people collaborate and keep hold of the data. I've already mentioned that there is this pending rulemaking that might extend the 30-day rule to 90 days. We should know soon about that, but until we do, we don't know. I do a lot of blogging at FinCENreport.com. That's a good place to check. I'm going to make sure to stay in touch with Peter and Ryan, and we'll certainly let them know if there are any updates so that we can share that with the entire Gust community. The way my system is going to work, once you've created an account with us and your data is ready to go, we're going to file through FinCEN's API, so you're not going to have to navigate what I'm sure is going to be a brilliant government website that we're all looking forward to seeing. FinCEN is also supposed to have a customer call center. They haven't opened it up yet. We don't know when they're going to open it up. Many of the people on this call have opened up customer call centers before, and you know how challenging that can be. I can't remember the last time I successfully got my way through to the government call center. Our software is a lot more intuitive. We also have online helps, and we're going to have other educational materials available to make it a lot easier to work with our software. So let's go on to the last slide here. So as a quick review, are you a reporting company? Are you exempt? You need to think that through. If you're not exempt, and most of us won't be, you need to figure out who are your beneficial owners by applying the percentage calculation rule and by applying the substantial control rule. These are complicated legal judgments, so we encourage you to work with your attorneys to get that done. For each beneficial owner, you go through the list there. You're going to have to obtain their full legal name, date of birth, home residential address, and then a unique identifying number, which could be a driver's license number or a passport number, and then get an image of that driver's license or passport. Definitely personal pieces of information, sensitive pieces of information. That's one of the reasons that my software exists the way it does. Let's go ahead, if it's okay, and jump on down to slide 16. I know that we're going to have a lot of questions here. This will be the one that has the two pictures on it, on the left and on the right. There you go. If you want to get started, you can go to FinCENreport.com and click on the Get Started button, enter your email, and you're going to get an email invitation from us. That will allow you to get in and get started. Go on to slide 17. Once you're inside, you log in with a username and password. This is going to go real fast, so let's go on to the next slide. And once you're in, we ask for your information. This is your name, your home address, and all that good stuff. Basic data entry right there. Go on to the next slide. Once you're inside and we have your information, you're able to interact with your companies. Now, we're going to have a process worked out with Gust so that if you're a Gust user, we're going to have your company name, state of organization, company type already keyed in. We're going to invite you in, and at that point, you'll see your company here. This particular individual is connected to 7 different companies, and they're seeing all of them listed here. You're going to see whatever company it is that you're connected to. Let's go on to slide 20. So this is just an example of what it looks like. If this was your company, it would say the name of your company across the top. From inside of there, you're going to need to double check and key in your company type, the state of organization, your EIN, the year in which you were formed, and then your company address. You're then going to click on that tab that says company members. And I think if we click on the next, there you go. Once you're inside the company members, This is where all the work takes place, okay? This particular entity, Bobby McGee Trucking, has these several different members. The ones that have the blue label there on the right-hand side that says beneficial owner, those are the ones that this company has decided are going to be beneficial owners. If they wanted to, this company could work with an attorney. What they would do from inside of this tab right here is click on the button that says admit new member or add new member, key in the email address of your lawyer or paralegal. You advance the slide. We're not quite ready to do that. If we just go back one, there you go. And when you're actually inside the software, not here in the demo, you would be able to click on add new member, key in an email address, and an email would be sent to the email address that you just listed. So this could be your attorney. You could actually use attorneys at different law firms. That's okay. They can all interoperate here. And they would then have a yellow advisor badge, and you would be able to see them inside of here. They would be able to then communicate with you about who should be the beneficial owners, make sure that those beneficial owners have gotten all of their information pulled together, and help you prepare to file. Let's go on to the next slide. Now, when you get ready to file, okay, you press a button under the My Filings tab, and what we're going to do is we're going to check to make sure that all of the data fields are complete. In this particular case, Bobby McGee Trucking is not ready to file because Tom Q owner has some issues. He doesn't have a full legal name. He doesn't have a date of birth. He doesn't have a completed identifying document. What you could do is click on that button. Let's not do it in the demo, but in reality, you'd be able to click on that button that says remind user, and our system is going to send an email to Tom Q owner that says, you're missing these three things. Bobby McGee Trucking can't complete its filing without you. You need to fill in these data fields in your personal account in order to let the company move forward. Of course, you know Tom Q owner. He's one of your investors. You can certainly pick up the phone and call him. You can email him. You can communicate however you communicate. But this remind user function is contained inside the software to make it easier for you to communicate quickly as you're working through the process. Once all of those issues are done, your filing is going to be able to move forward. We're then going to ask you to pay a filing fee that's going to cover the first year of service. Let's go on to the next slide. No, it should be slide 24 at this point. There we go. So we talked about all these individuals who are logging in. All of those individual accounts are free. All of the advisor accounts are free. So you have lawyers, accountants, paralegals. They can come in and interact with you. They don't pay anything. You can work with as many as you want, and there is no charge on any of those people working. The only fee that we're going to charge is $199 per year, and it doesn't begin until you go to file that first report. When you do, we're going to ask for the credit card at that time. We're going to take the $199. It covers the first report, and if any of your beneficial owners should have a change in data during the year, the way the system works is as soon as they key in their data in their personal account, we're going to flag every company, every reporting company in our system that they're connected to, and tell those reporting companies they need to file an amendment. Remember, the amendments need to get done within 30 days of the date of the event. The company will then be able to file that amendment with the click of a button, and there will be no additional charge for that amendment. $199 covers the entire year and an unlimited number of amendments. Let's go ahead on to the next slide. I'm going to give you one quick example here. You've probably already intuited where this is going, but so we have a startup corporation. It's Larry, Bill, and Sally, and each one of them has 1,000 shares of stock. Let's assume that Larry's the CEO, Bill is the CFO, and Sally is the head of marketing. And each of these three individuals are the three members on the board of directors. Sounds like a pretty standard startup. So who would be the beneficial owners in this case? Let's go to the next slide. Now, each of Larry, Bill, and Sally has 33% of the outstanding common stock. So applying the corporate capital rule, each of them has 33% of the vote. Each of them has 33% of the total combined value of the company. And that outcome is reasonably certain. It doesn't really matter whether it's $1 billion or $100. Each of them has 33%. So each of them is a greater than 25% owner. Therefore, each of them is a beneficial owner. Now, just to be certain, we're also going to go through our substantial control test. Larry is the CEO, which is a senior officer by definition, so he is also a beneficial owner by that reason. Same thing for CFO. Sally is the head of marketing. That is not a senior officer role. Even if she has the title Chief Marketing Officer, that is not defined as a senior officer in the CTA. So we would not include her on that basis. She is included because of her ownership, but not because of the senior officer title. Also, because each one of them is on the board, each one of them has substantial influence over major decisions, since the board makes decisions for the corporations. So each of them would be a beneficial owner by that reason as well. So your final answer is Larry, Bill, and Sally are each beneficial owners. Let's change the facts just a little bit as we go to the next slide with example number 2. Same thing as before. Larry and Bill and Sally form the corporation. But in this case, Larry and Bill get 1,000 shares. Sally only gets 100 shares. Again, Larry is CEO, Bill is CFO, Sally is head of marketing. Who are the beneficial owners now? Let's go to the next slide. Well, with 2,100 shares outstanding, Larry and Bill each have more than 47%, so they're over 25. Sally is less than 5, so on the basis of ownership alone, she is not a beneficial owner. Looking at substantial control, again, Larry's the CEO, so he's also a beneficial owner by that basis. Bill is the CFO, so we count him. Sally is head of marketing, not defined as a senior officer, so she would not be a beneficial owner on that basis. But because she's on the board of directors, I think she still does have substantial control over important decisions. So on that basis, I would include her. What if the facts were changed just a little bit? What if Sally was not on the board? Well, in that case, I think Sally would probably not be one of our beneficial owners. I've got another example for you here. That's okay. We can go to example number 3. In this case, Larry, Bill, and Sally have the corporation. They each have 1,000 shares. And Blackbeard, the corporate pirate, comes along. He invests $1 million. He gets 1,000 shares of convertible preferred. It converts 1-to-1 into common. Let's assume that there are anti-dilution rights and there's an accumulating dividend just for fun. Let's also assume that Blackbeard has the power to appoint one person on the board of directors. Who would be the beneficial owners in this case? Let's go to the next slide, find the answer. Well, just like before, we first have to do our fully diluted equity analysis, converting all of Blackbeard's preferred into common. Now we have 4 shareholders with 25% each. Each would be a beneficial owner on the basis of percentage ownership. Next, we would have to look at substantial control. Again, Larry and Bill are senior officers. We count them. Sally is not. We don't count her. But the 3 of them are on the board, and Blackbeard has the power to appoint one person to the board. Being prudent, being conservative, we probably treat all 4 of them as beneficial owners on these facts. So let's go to the last slide. I mentioned earlier there's a $500 per day fine. It's probably the case that FinCEN is not going to be very strict about this because they want to build a database of companies. They're not really in this for the money to ding people with fines, but because there are potentially criminal penalties associated with it, we want to be really careful with getting this stuff right and getting it done on time. The personal criminal liability rests with the senior officers. So you could be a founder, you could still own 50% of the company, but if the company doesn't get it right, at the end of the day, it's the senior officer who's potentially at risk of handcuffs if the senior officers don't get this stuff done. I am advising clients to adopt a CTA compliance policy, to review their shareholders agreements, review their LLC operating agreements to make sure that they're up to speed, and think through these issues with counsel well before the deadline, because I can tell you there is going to be a heck of a rush at the end of next year as we all try to get this stuff done. So I can go to the next slide. That's where my presentation ends, but I can see that there are lots of questions in the chat. So Peter, what's the best way for us to work through some of these questions with the group?
Well, I will group them together and shuffle them over to you. And first, just thank you for the overview. And just to give everybody a little bit more information, if you are a Gust Launch customer, we're going to be working directly with FinCEN Report to provide you this solution. Eventually, we want to make it even more streamlined, but what we are seeing is that the next year is going to be full of a lot of questions, likely a lot of changes and a lot of clarification points. So right now, our priority was to get a comprehensive solution that would cover you. So Gust Launch customers, we will get you into there. You will receive invites. You will also get reminders on your Gust Launch dashboard. For the rest of the Gust community, We wanted you all to be aware of this and to have a potential solution. FinCEN report came highly recommended through our filing partners at HBS. So we are excited to have something. We are hopeful to provide something more streamlined as we learn more over the course of the next year. All right, with that said, I think the first things to talk about, we have a couple questions around, I have a company that hasn't made any revenue. I am the only owner. This is asked for an LLC and a C Corp. Do I still have to file or am I an exempt entity?
So there is an exemption for inactive entities. I don't get that one very often, so I want to pull that up in front of me here before I quote it from memory. But the requirement for an inactive entity, and by the way, this is my book. It's got a copy of the regulations in the back, so I use it as a cheat sheet every day. To be exempt as an inactive entity, first, the entity has to be in existence before January 1 of 2020. Okay, so it has to be kind of old. Has to be not engaged in any active business. So if you have a website saying that you're out there selling something, you're probably not inactive. You have to not be owned by a foreign person, directly or indirectly. You have to not have experienced any change in ownership in the preceding 12 months. You have to have not sent or received any funds in an amount greater than $1,000 in the preceding 12 months. And you cannot hold any assets, whether in the United States or abroad, including any ownership in any other entity. So you have to truly be defunct, and you have to have been defunct for at least 12 months and have been in existence since prior to January 1, 2020, in order to be exempt because you're inactive.
Cool. And again, this is going to be gray area for a lot of people who are maybe put a stake in the ground by forming an entity early on to limit liability, but are kind of meandering towards the point where a startup or business might actually get real and take off. So it will be one of those, one more thing on the plate of a startup founder to understand risk versus compliance cost, unfortunately. But just to be very, very clear, if you do have a website, you are actively working on something, you are planning to sell something, but you aren't making any revenue yet, the lack of success in the entity and revenue coming in does not automatically exempt you. The fact that you have a corporate entity, even if you are only the sole owner of an LLC or corporation, you still are not exempt by default just because you don't have any revenue. Okay. I think you actually covered this. The next question was what the inactive entity exemption actually means. I think you covered that very thoroughly. And you kind of hinted on this in the definition of the inactive entity exemption, but what if beneficial owners are actually other entities? How does that all flow down and through?
That's where things get really complicated. Again, you're going to need to consult with counsel. Depending on the type of inactive entity, you might have to look up the corporate chain to see who are the beneficial owners of that thing. I was on another webinar 2 weeks ago with a bunch of family offices and Swiss banks, because they all have these elaborate trust structures where the wealthy guy has the money in the trust makes the investment in the US LLC. And the FinCEN rules say that the US LLC has to report the ownership, and the owner is the trust. Well, when the trust is the owner, who do you report? Well, the regulations give us an answer to that. They get very complicated, don't need to go into it. But depending on the facts, you might have to look up past the corporate entity to find who are the ultimate individual beneficial owners of it. Or if that owner is itself an exempt entity, like Microsoft owns 10% of your stock, you don't have to figure out who the beneficial owners of Microsoft are because it is an exempt entity, because it's a public securities issuer. You would just put down Microsoft on the form with respect to it and its ownership stake. Again, it's so darn complicated, though. You got to have counsel involved in this stuff.
Yeah, and again, the stuff is emerging. I think a good rule of thumb is if you look at a company that owns shares or is otherwise involved in your company as a beneficial owner, that company will likely either have to report on its own and be reported by you, or you may have to dig down through to the individuals underneath that, depending on the corporate structure. If it's an LLC and a pass-through, likely you'd be reporting on the person directly. If it's a corporation or a more complicated entity, there are question marks.
That is correct.
Okay, let's see, what else do we have? Oh, this is an interesting one. Differentiating titles from controlling roles. Obviously, there are a lot of room for companies to give titles that are titles only or significantly different from roles. You mentioned this a little bit with the janitorial analogy earlier, but where's kind of the line if you have somebody who is chief product officer, who obviously has a very important role in pushing the company forward, but may not have an actual governance role and control in the governance of the company. Where does the line approximately land?
Right.
Understanding that you can't give legal advice.
well, even if I could, there is no clear answer. The FinCEN regulations literally tell us that what controls is the reality of the situation. How are we supposed to know the reality? What they're trying to do is avoid what I would call a Tony Soprano situation. If you remember, there was the Italian restaurant, and Tony didn't own the restaurant, but he kind of treated it like he did. He took money out of the cash register. He would show up at all hours of the day and night. He had his own set of keys. He did whatever he wanted. Tony operated just like the CEO of the restaurant, even though he didn't own anything and he didn't have an official title. That's the kind of situation that the regulations are intended to avoid. So that if Larry, Moe, and Curly are the three senior officers, but Tony Soprano is off in the corner truly calling the shots, it's a violation that Tony isn't listed. Now, in the case of your chief product officer, I would say do your best to report what the reality of the situation is. A CPO who functions like a CEO is functioning like a CEO.
Yep, and I think like everything else that we talk about when it comes to compliance and filing, whether it's security exemptions or filing here, you want to present a good faith effort to present the truth of the actual situation. Like if you wipe the titles away, obviously anybody who on paper owns 25% or more of your fully diluted capitalization based on issued shares is going to be a beneficial owner. Anybody who is on the hook as a board member or an officer of the company, absolutely. And for most of the companies that we are working with, hopefully all of them, the facts of the situation will map very, very well to the actual governance roles, and there's not going to be anything questionable happening. So doing your best to map that directly to what you need to file and make sure that that is indicative of reality is just the way to go. The government is not trying to pin you down necessarily, especially as a small company, on a slight misunderstanding of the rules. They are trying to create a set of rules and regulations that allow them to ensnare people who are doing shady things. So by and large, making the effort to comply and be truthful about the facts of the situation and not doing shady things are the best way to avoid the bad stuff. All right. Next one up. If somebody did want to actually go through and register themselves and do the data reporting themselves, what should be top of mind for them? Is it possible? Is it like filing your corporate income taxes where it's like, yeah, it's possible if you're a CPA and you really want to dive in and do it, but it's suggested that you work with a professional to get this done because X, Y, or Z. What's your purview on that?
Right. Well, I have to advise everyone to get legal counsel. This is complicated stuff. It also, we don't really know. FinCEN is supposed to put up a website on fincen.gov, and it's supposed to go live before January 1. Maybe they put up a beautiful, well-adjusted website, and they've had expert UX designers making this thing intuitive, in which case many companies will be able to do this on their own through the government website via Condios. I hope that works for you. If that doesn't work, you're going to need a filing solution like ours, and you're probably going to need advice of counsel to figure out the rules. I've been working on this for 2.5 years, so I can sort of spit this stuff out. Like I said, I wrote a book on the subject. You can go buy the book from LexisNexis if you want and try to do it yourself. My dad still does his own taxes, so maybe that works for you.
Yep, and again, referring back to startup gray area territory, this stuff is tough, right? So you have to make a judgment based on your level of expertise, the level of value currently in your company, and where you want to invest money versus where you want to invest time. There aren't clear answers. And hopefully you have a network of folks like us, like FinCEN Report, to help you navigate this stuff in a way that it makes it less burdensome, is still relatively affordable. It is a difficult situation, and we are having this webinar today, and we are working with FinCEN Report because there are just a lot of questions and unknowns. Likely, again, we're going to learn a lot over the course of the next year. We just didn't want you all to be unprepared or not know of what's coming ahead, especially for those of you who are in the very early stages and maybe don't have counsel yet, and this might not even be on your radar. So that's really the goal today, is educational, and we'll do our best as a community and as a platform to make sure that you have a clear path to complying. Next up, I think this was answered in chat, but I think it's worth touching on. Question was, okay, so if I created my entity before 2024, am I exempt? And I think the very simple answer here is no.
An entity that exists before January 1 has until January 1, 2025 to file their first report. You're not exempt, you just have that much time.
Yep, so you get a little bit of extra time because you have existed. If you incorporate on January 1st of 2024, then the current regulation is that you will have to file within 30 days. It sounds like they are thinking about extending that a little bit beyond 30 days to 60, but no finalization on that yet.
That's right. There's a pending rulemaking that would give us 90 days. I also spotted a question here in the chat. Someone is asking, is it greater than 25% or 25%? And the answer is 25% or more. So equal to or greater than 25 is the rule.
Yeah, and notable that this is the same as the rules for when you open your corporate bank account. Anytime you see beneficial owner here, corporate bank account, it's usually 25% or more.
A little bit be careful. There's a slightly different set of definitions for the KYC rules than for this.
Oh, good to know.
FinCEN is actually supposed to harmonize those rules, but they haven't gotten around to it yet.
Okay.
So then we have two sets of beneficial owner rules. Yeah.
And we have another question in the Q&A around whether or not FinCEN is ready to use. And I think we should clarify, FinCEN is an existing entity task force that is charged with doing these things. The Corporate Transparency Act is the legislation that has passed that involves reporting to FinCEN, and there is supposed to be the release of a platform and API in time for everyone to meet the compliance dates and deadlines. But that platform and that API, we do not have final documentation of what the API is going to look like, and the platform has not launched yet. So none of that is available.
That is correct. Now, some people like to get confused. My company is FinCENReport.com. Our software is ready to use. We've got all our stuff working. The only thing none of us can do is actually file the report yet, and we can't do that until FinCEN, the government, opens its own portal.
And for some clarity, if you are a Gust launch customer, what we are planning to happen, and we are still working on the rollout with this with Jonathan and his team, is that you will get reminders on your Gust launch dashboard and via email about what these deadlines are. And we are planning to do basically a bulk import of our companies into the FinCEN report system. That will just be email addresses and names of the primary owner of the account, which means that you will receive an invite to optionally utilize the FinCEN report software in order to do this. So we will let you know about the deadlines, and we will give you one potential option to go down. We believe it is the most cost-effective at this point. We will give you that option. You are free to take it or not take it. That is up to you. And as Jonathan mentioned, you are welcome to claim that invite, explore the software, see if you're comfortable with it. You will not be asked to pay anything until you make the first filing.
That is all correct.
Okay, I think, we do have one more question. Keith Shepard mentions that he is a registered agent and they have many clients who are required to file. Would you consider partnering with companies like his to sell your platform to his clients?
Yes, we would. In fact, we've already done so many times. It sounds like Keith was not at the NPRRA convention, but all the registered agents there got our presentation. We have already made several press releases of other partnerships we've done. So Keith, find me on FinCENReport.com and we can talk.
Yeah, and Jonathan, if you don't mind, I will just connect the two of you via email directly after this.
Even better. Thank you.
Okay. I think we are ending a little bit early. If anybody has additional questions, please get them into chat and Q&A now. Oh, we do have one more that I missed. Does it affect your filing if some shareholders have a one-year cliff or have not vested their shares yet? This one's going to be a little bit tricky. So before I hand it over to you, Jonathan, if they have received restricted shares of common stock, then yes, it will include all of the shares that they were issued, even if there is reverse vesting on those shares, and the company can recoup them because they do immediately vote those shares having received them, and vesting on their restricted shares is reversed, so the company can claw them back, but they belong to the person from a governance perspective immediately. Now, if we're talking about options, it's going to be forward vesting, and they won't be shareholders yet. So in that case, Jonathan, I don't have clarity. I will pass it over to you.
Sure. And here you can tell that the government employees at FinCEN who wrote the regulations are not experienced startup folks. The rule that they wrote, remember at the present time rule, we treat all options and convertible instruments as if they have been converted, regardless of whether or not they're actually exercisable. They assumed full forward vesting, and that's how we're supposed to do the calculation. They didn't give us a rule for clawbacks and reverse vesting. But I think that Peter said it exactly right. If you own the shares today, you're going to be treated as owning them for the modified, fully diluted calculation you have to do. But again, got to put it out on a spreadsheet, got to get a lawyer there with you to read through the regs as you try to do this calculation.
Yeah, and again, one thing to keep in mind too is, very unlikely that a stock option holder is going to own 25% or more of your company as a shareholder. Like, you don't see a lot of stock option grants that that hit that threshold. So if you think about it logically, if you do have a stock option grant that hits that threshold, alarm bells are going off in FinCEN's head and saying something's fishy here, right? So anytime anything that could be construed to be trying to work around the rules is likely going to be construed exactly in that manner. Granting an option grant rather than restricted stock is not a way to have somebody not be a beneficial owner.
No, it's definitely not. In the book, I actually give a whole bunch of examples, and there's one where there's a 25% shareholder, and then there's a 20% option pool, all of which have been granted. And when you calculate the fully diluted equity, the 25% common shareholders shrinks below 25 and actually ceases to be a beneficial owner. But that was an edge case that was just for educational purposes.
Yep. All right, and one more thing I think that will be helpful to clarify, just to confirm, once a filing is done, there is not an automatic necessity to renew it on a yearly basis, only when there are changes to beneficial ownership or the PII of the existing beneficial owners. Is that correct?
That is exactly right.
Okay, awesome. Well, all right. One more question in here from Bill. Bill, we will not be able to verify for you if you need to file it or not. That will come down as a legal opinion. We will be able to give you, as a Gust customer, as a Gust launch customer, information on what terminology means. We will be able to clarify questions, point you to FinCEN's FAQs, and give you the outline. But ultimately, the judgment will have to be on you and your counsel, because we cannot make legal judgments on behalf of your company. I wish it were simpler. It is not. Okay, I think that actually brings us to the end. Thank you again, Jonathan. Thank you, everybody, for being here. We will distribute both the slides and the recording, just so you all have some information. And this is not the last you will hear about it. Don't sweat it too much. We will keep you prepared. We will keep you updated as we get closer and closer. And we will do our best to answer questions, both Gust and FinCEN report, as we get closer to those deadlines. So thanks, everybody. Jonathan, any parting words?
Appreciate the opportunity. Appreciate everyone's time and attention. Hang in there, do your best, and stay in touch for more information as it becomes available.
Absolutely. And Ryan, thank you for running slides so I could run chat and Q&A.
Yes,
all right, everybody.
Thank you for training me, Jonathan.
It went off remarkably well for all of that. All right, all. Thanks so much for being here.
I appreciate it. Oh, Peter, if you wanted to send privately all the questions that came